The market is open and we're starting to see a recovery from the drops that we saw yesterday, and today our focus is on Meta Platforms. Now, they reported after the market closed on Wednesday, and we're going to take a look at their earnings, understand what was positive and some things we need to keep an eye on. We'll also talk about whether or not we believe it is a strong buy. Like Wall Street say, they see this still as very undervalued. In fact, whilst you may believe it has been on a run over the last year, up 82%, it is still trading at a forward P of 25, one of the lowest in the Mag 7 and pretty much in line with the S&P 500. Now let's get to their earnings, and we can see the main thing, or in fact where they actually missed out on, was on the user growth, something that Wall Street keep a very close eye on. And another bearish signal to the market is that they are expecting to continue to increase their spending on AI. Now, this isn't something that shareholders want to see or analysts, and therefore that is some part of where we got that 5% drop yesterday. And we can see 3.29 billion daily active users. However, Wall Street did want to see around 3.31, and that is where some of the bearish sentiment came from in the market yesterday. And as we already mentioned, they are expecting to grow significantly that spending in 2025. Having said that, their earnings per share was absolutely phenomenal, 603, much better than the 525 expected, and their revenue was also a very nice beat, as we can see here, 40.59 billion versus the 40.29 expected. We also note that is a 19% increase on their top line from the same quarter, and even better, their bottom line is up 35% to 15.7 billion, massive growth from the same quarter last year. As we've already mentioned, their daily users were lower than what the market wanted, but that is still up around 5% in comparison to the same quarter last year. As we can see, they have raised their expected spending 38 to 40 billion, and what was anticipated 37 to 40. So very marginal increase, but again, these small increases are the difference between analysts liking it a lot, seeing the share price move in a favorable way, and getting a drop, whether that is a small or large drop at all. We also noticed the CEO mentioning that AI investments are going to continue to require some massive infrastructure, and therefore they expect this spending to continue at a very rapid rate. So whether you believe that's positive or not, when we do come to look at the actual share price, we can see very strong performance over the last 12 months. Over the last 10 years as well, massive outperformance of the S&P, 688%. And no surprises, especially if you've been following this company, it was trading 2 years ago at under $100. Now, right now, it is still trading in the upper end of the 52-week range. Even after the small pullback that we saw in their earnings, their all-time highs do sit around $603. We have a buy rating from Seeking Alpha, a strong buy as previously mentioned from Wall Street, and even though we get a hold from Quant, 3.5 is what would turn this into a buy, so they are pretty much sitting on the fence. Now, we've already mentioned the forward P, which we don't believe to be that bad, 25.15, and in terms of the yield, 0.35%, similar to Alphabet, a company that only recently initiated the dividend. Now, what we quite like is that the next 4 quarters, they are still anticipating massive growth to the EPS year on year, next quarter around 25%, and they've also outperformed massively, something that now we've come to expect from this company. They do typically beat 100% track record over the last 4 quarters, and December 2025, their EP estimate around 25 is anticipated to lower that forward P to 22.71. Now, when we get to some of their metrics, dividend safety score 70, we'll take a look at these models, but understand they've only just started to pay a dividend, so we won't have all of the metrics. Now, it was reaffirmed on August this year that their dividend is safe, ultimately meaning that a dividend cut is unlikely. And when we get to how they performed in the last recession, well, no dividend was paid, no comparative data, but look at that recession sales of plus 154%, well above the average of the S&P, which was negative 12 during that time. Now, when we look at the 5-year average P ratio to understand where it sits in terms of the expected fair price, we actually notice for the large part of the last 12 months, it has been trading towards the upper end. Right now, based on the current value, even after the drop, it still sits right on the edge of overvaluation / reasonable valuation. And when we look at dividend yield theory, this is something we look at for every company. It tells us a company is undervalued when the current yield sits above the 5-year average. Right now though, what we can see, it is sitting marginally below, but remember they've only recently paid, so probably not relevant for the time being. When we look at the forward PE, sitting at 23.4, not far off the 5-year rolling of 22.8, so you could argue reasonable valuation. We do, however, note it does sit higher than the sector PE of 18.9, but remember we would class this as a high quality company and does deserve a premium to the overall sector, as we will show you in comparison to the sector metrics. Now in terms of the free cash flow payout, remember we do avoid earnings, which is susceptible to manipulation by management through accounting. Below 60% is what we want to see. It's 11% over the next 12 months, so similar to when we reviewed Alphabet, we expect Meta Platforms to also have very nice growth moving forwards. Then we get to the free cash flow year on year. Consistent increases over the longer term is what we want to see. It has grown at a very rapid rate and is expected to continue the upward trajectory over the next 12 months. Then we get to sales growth. Now, whilst it does look like it has started to slow down, it is still well above that 3 to 7% minimum we want to see. 2023 at 16%, trailing 12 month at 23% does show us that growth is still there with this very large blue chip company. Then we get to the total sales. From a numerical standpoint, it's more than 10 times over the last 10 years, expected to continue. Just look at that trailing 12 month at 156. And then when we get to these shares outstanding, we actually see they've done a lot of both issuing shares and in fact buying back shares, but the net position over the period is very trivial, only buying back around 40 million. Now something clearly they are looking to do from 2020 where they have done those share buybacks, but again something we can look at, and always good to see how a company decides to allocate its capital. Now speaking of capital, ROIC, one of our favorite metrics, 10% or more, give us faith management are able to effectively allocate their capital, and we can see very strong numbers increasing as well, 31% on a trailing 12-month basis. Investors do love to see this. This is a very important metric. Now operating margin, we want to see above 12%, but we'd ideally like to see operating efficiency with margins increasing. Whilst we don't really get that for Meta, we still notice it is very high. 42% on a trailing 12-month is very good to see. And then we look at the free cash flow margin. Again, inconsistency, but the numbers year on year are very, very strong. We do like that 34% on a trailing 12-month. Then we get the net debt to EBITDA, earnings before interest, tax, depreciation, amortization. Below 3 is what we want. That is what we see. And the number below, or lack of, are the number of years it would take the company to pay off all of their debt net of cash on hand. It won't even take Meta 1 day. And remember, because this correlates to balance sheet strength and dividend safety, as we will come to show you, their balance sheet does look very, very strong. Now, we just want to let you know we have released our latest weekly article. This one runs through 40 undervalued stocks for the month of November. As always, we drop one to your inbox every single Monday morning, talking about undervalued stocks we believe deserve your attention, as well as essentially what's happened in the market over the last few days. So click on the pinned comment below, sign up, and you can read straight away. As we mentioned, you can grab this copy of undervalued stocks for the month of November that we have just released this morning. And also on top of that, you can grab a spreadsheet showing 22 undervalued dividend stocks that have the most upside in the S&P 500 over the next year, according to Wall Street. So do click below, sign up, and you can read straight away. Now, a few things to show you from their latest investor presentation. We can see their revenue over the long term has been increasing. Q3 up from the previous quarter in 2024, but also when we look at that in the 2023, they reported 34 billion to the top line. We can see they've just reported 40 billion, so growth is continuing over the longer term. When we get to their segmental results, now maybe revenue is something you want to look at, and as we saw based on that bar chart, it does increase over the long term. But what we want to draw your attention to is the operating margin. It was 20% in Q3 2022. Then we see 40% in Q3 2023. And as we can see in this latest quarter at 43%, we are starting to see those operating efficiencies that we were discussing earlier. We then also really like something that maybe isn't talked about as much, is that their expenses as a percentage of revenue is starting to come down. They are finding efficiencies in the overall business, and that is how they are able to increase that operating margin. So that is very positive to see. We can see in pretty much every segmental analysis, each part of their costs, whether it's their general and admin, marketing, sales, R&D, or the cost of revenue, are starting to trickle down. That is a very good sign and will ultimately affect the bottom line. As we can see here, net income therefore going up. So looking very good in terms of management as well. So we do have to say they are doing a great job. EPS also going up. These are all the metrics that investors will want to see, and the same to be said for the free cash flow as well, something that is very important on this channel and will ultimately become the makeup of our valuation towards the end of the episode. Now, other parts that we look at is insider ownership, around 14%, 1.24 billion worth of sales just over the last year. And when we take a look, around 4 million of sales in the more recent quarter. When we see who these insiders are, well, we can see, in fact, just a few days ago, one insider sold around $500,000 worth of shares. And then we also get quite a few in the month of October, as we said, for a few $1 million in totality. Whether or not, though, you do believe this is a bearish signal, information is there. But as we always say, for us, it isn't one we consider, as ultimately insiders sell for many reasons, personal and financial. Ownership from the institutions, 80%, 31 billion worth of sales over the last year, but pretty much double during the same time frame. And we also notice a significant amount of buys in Q3. So overall, institutions and in the more recent quarter are buying a lot of shares, very bullish on this company. But do your own due diligence as always, but never copy what these insiders do. Now, we've already looked at their revenue. As we said, it has been growing at a very rapid rate, more than 10 times from 12.5 billion in 2014 to 135. But what we really want to focus on is the bottom line net income. Does it tell us a very similar story? And the answer for the large part is pretty much yes, moving in that right direction. 3 billion in 2014, 40 billion or just under in 2023. So we're seeing growth to their top line revenue, growth to their bottom line net income, as well as in the more recent period, growth to their operating margins. Then we look at the health of the company, just reiterating what we saw earlier, that it's very, very strong. Cash also increasing like the majority of their metrics, going from 12 billion in 2014 to 71 billion in the latest quarter. Remember, never focus on one metric on its own in isolation. We always like to compare it to their total debt numerically and directionally, which has actually gone up over the last few years from around 233 million in 2014 to 49 billion in the latest quarter. But as we just saw, their cash is far superior, and as we mentioned, it wouldn't take them one day to pay off all of their debt net of cash on hand. We then move on to the valuation, where they get a D-. Now PE sitting around 25. Remember, we already discussed it is higher than the sector. In fact, that comes around 14. So you are paying an 84% premium right now. Does it deserve the premium? The answer is probably yes, but how much of a premium? Something we'll get to. And we can see no matter what valuation metric you use right now, Meta does trade at a very high premium to the overall sector. Now growth B+, so revenue year on year 23%, with the sector at 2%. Moving forwards around 17%, sector median around 3%. And when we look over the next 3 to 5 years, they're expecting this to grow around 22%, a lot better than the overall market at 10%. Then we get to profitability, A+, phenomenal margins, 82% on the gross versus 52% of the sector median. Bottom line, much better, 36%, sector median at 2.6%. And then we look at their cash from operations, 83 billion over the last 12 months, much higher than the 278 million from the sector median. So quick recap, buy from Seeking Alpha, strong buy from Wall Street, hold/buy from Quant, D- on valuation, B+ on growth, with an A+ on profitability. Now before we jump into our own valuation model, let's compare them against others in the sector. And when we look over the last 12 months, it is up 83%, including the dividend reinvested. Very strong, in fact the best performing. Over the last 5 years, we can see again the best performing, and over the last 10 years, absolutely phenomenal. Can it continue the amazing run it's had? Something definitely to question, especially if you are considering adding this to your portfolio. And something to show you, over the last year, over the last 5 years, and over the last 10 years, Meta has significantly outperformed the S&P, so definitely one to consider for the portfolio, but can it continue that very strong run moving forwards in your investment horizon? Something just to ponder. Now let's jump into the valuation model. As always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now our intrinsic value, $657 through the DCF model. We've got the free cash flow year on year, average growth 36%. We've gone for a lot more conservative at 12. In fact, we have a low, medium and high. With that and the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can see, 657, indicating 17% upside. Now remember, these numbers are subjective and you can grab a copy of this model by clicking on the pinned comment below, running your own numbers, whether it's for meta platforms or any others that you do desire, but we'll show you for transparency at the 10% point, pretty much trading not far off the current price, giving it 1% upside, you could argue fair valuation, and for those that believe it should be higher, at the 14%, 755, 34% upside. So we'll take the median rate in today's episode at 12% to the final slide, where we'll always use a MOS of 10% to begin with, and we execute on this if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. That is a buy then at 10% up to $592, and then we keep going till it's near the current trading price. Not a 15% MOS just yet, so we believe meta platforms is trading between 10 to 15%. For those that want to see, well, at 15% we saw 559, at 20% around 526, and at 25 under $500 at 493. So 10 to 15% MOS, we already said Wall Street have a very strong buy. They are bullish on this over the next year and beyond. Upside of 16%, their price target $655. Do give us your thoughts below. Is it still looking a little bit too costly for you? Remember, the forward P right now around 25, in line with the S&P and one of the cheapest in the Mag 7, or is it a hold or a potential sell? Give us your thoughts below. If you enjoyed the episode, smash that like button, hit that subscribe and bell button. Don't forget to sign up to the free weekly newsletter below. And as always, join us in the Patreon where we do talk about our weekly buys and sells. Have a great day, and we'll see you all on the next one.